There's one very clear thing that comes out is that sanctions rarely work.
Some of the sanctions against Russia, of course, go all the way back to 14, they're 10 years on.
On the outbreak of any of these conflicts, there was initial market reaction, but markets kind of went back to normal.
We're seeing companies all over Europe selling goods to Russia via Turkey, Kyrgyzstan, you name it.
Europeans did end up buying Russian oil, but via India. So the import was technically from India, but really it was from Russia.
These conflicts are beginning slightly to merge now.
The US is a winner, Europe is clearly a loser.
A Trump victory in the US elections reduces sanctions.
Hello, and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik, and my esteemed co-host is Sir Michael Fallon. Our guest today is Bilal Hafeez, founder and CEO of Hive. Bilal, hello. Very nice to have you on the podcast.
Great. No, I'm very happy to be on the podcast, and I look forward to having a conversation with both of yourselves.
So the topic which we wanted to discuss today is related to the geopolitical and geoeconomic tensions that we have witnessed in the recent years. We have seen an imposition of sanctions on a number of countries, in particular on Russia. We are speaking now about imposition of sanctions on some companies in India and China. We are seeing a potential President Trump speaking about tariffs on some Chinese goods. And the interesting part of this story, which is very often overlooked, is the cost of these barriers and the potential risks which those barriers bring along. Recently, I have seen an estimate that the war in Ukraine has cost the German economy about 200 to 250 billion euros, which are lost in terms of their GDP and mostly in exporting industries, which are the backbone of the German economy, which employ the most competent, highly paid people. And clearly, this should have an effect on the markets. So what's your view on the cost of the tariffs, which we have seen in the recent years?
No, it's a great question. And I would first of all say that the part of the context for all of this is the world since COVID, which in general did lead to lots of supply chain issues in any case, outside of sanctions. And you've also had a big push by countries around the world to try to onshore production. So the context in general was one where you have a fragmentation of globalization, which in general is inflationary because in essence, you're moving away from the locations with the cheapest cost of production and moving it instead to more expensive locations of production to ensure resiliency. So the general context is one of inflation. Then if you throw on top of that sanctions on a place like Russia, which is an energy producer, then you suddenly add another inflationary force, on the energy side. And energy is one of those commodities which affects obviously it directly affects certain sectors, but in the end, it affects every single sector because it's energy after all. And in Germany in particular, if you look at German, say, real GDP, there was a big collapse in the size of the German economy, real GDP after COVID, just because of the lockdown. Then it recovered to its pre-COVID levels, but it hasn't really grown much since, whereas the US has grown significantly since COVID. Now, why is that? I think a big reason for that has been the sanctions on Russia. So in essence, Germany's economic model was to import cheap Russian energy, use that to do some clever manufacturing, and then export out to China, to simplify the model here. What's happened now is that they don't have that cost advantage on the energy side because they've had to switch away from cheap Russian energy. Instead, they're importing much more expensive US, Qatar, and Australian LNG. They've had to build terminals and so on, so that the cost of energy production has gone up. And then more generally, exports to China have gone down. That's partly because China is manufacturing a lot of stuff themselves. And in fact, China has become a huge car exporter. But also what you're seeing is German companies themselves are shifting production facilities to China where there's cheaper energy locations. So there's a number of German companies that are shifting production out to cheaper energy sources. So I think it has had a big impact on Germany in particular and on Europe more generally. So this has been the trade-off that we've had to see in this specific case.
And how, Bilal, do you approach, your strategy when it comes to sanctions? Do you look at the effect of past sanctions and you build in some assumptions about how sanctions actually change the economies that they're being applied to? We've had sanctions for a number of years now against a number of different countries. Do you look at this in a kind of academic way as to what the effect's been elsewhere, or are you simply monitoring them as they go along?
We kind of do both. I mean, in the case of, there's been so many sanctions across multiple countries across time that you have lots of interesting sort of parallels. So, in the case of Russia, what we looked at more specifically was sanctions on Iran that were imposed in an earlier period where their, oil exports were reduced. But what was interesting about the sanctions on Russia was that the way the sanctions were imposed on Russia, especially on the oil side, was different to Iran. Because in the case of Iran, the intention of the sanctions was to reduce the amount of exports that Iran was doing. In the case of Russia, it wasn't to reduce the exports, it was to reduce the revenue. So it was basically to force the Russians to get less revenue from oil, but for Russia to continue to produce as much oil as possible. In fact, Russian production is almost as high as it was before the invasion of the war. So there are historical parallels you can look at, but then you also have to understand the intent of the current set of sanctions and then work out, how that has an impact on things. And then the other thing, when we have studied sanctions around the world, is one very clear thing that comes out is that sanctions rarely work. They don't really work on multiple different fronts. They don't often work to achieve the political objective. They don't often work in terms of the immediate intent either. So you tend to find people find a way around sanctions. And so in the case of, say, Russia, what you found there was that Russian oil, although it was sanctioned and Europe said they wouldn't buy Russian oil, and the Europeans did end up buying Russian oil, but via India. So essentially, India received cheap Russian oil. It was then refined in India and then sent back to Europe. So the import was technically from India, but really it was from Russia. So people find ways to get around sanctions as well.
It's quite interesting, one of the basic rules about implementation of sanctions is that if you are not allowed to do something directly, you are also not allowed to do the same thing indirectly. And nevertheless, we're seeing companies all over Europe, and not only Europe, selling goods to Russia via Turkey, Kyrgyzstan, Armenia, you name it. And as you have just suggested, they buy Russian oil or oil products via such jurisdictions as India.
Yeah, I mean, I think there's kind of two things that happen here. One is that in almost all cases, you don't have a global consensus on the sanctions. There's different alliances, there's different relationships. So in the case of Russian sanctions, it was in reality, it was really a Western sanctions on Russia. The South or emerging countries didn't have the same view. China didn't impose sanctions, neither did India, neither did Brazil. So it was very specific Western sanctions. So the rest of the world, just said, look, we're not going to impose sanctions. The West didn't care about issues in our countries, when we asked the West to impose sanctions. So why are we going to join the West in that respect? So one is alliances are different. You have to understand, which alliances are involved in sort of given sort of level of sanctions. And the other one is just even before that is an economic imperative every country. So even within Europe, where the Europeans, in theory, should all be aligned in relation to Russia, a country like Italy will say, look, we've got an inflation problem. We've got to deal with our local population. So we actually do want this cheap Russian energy, or we do want X, Y, and Z. So if there's an economic imperative, especially in an inflation environment, people will cheat and break the sanctions. So I would say the two things. One is the alliances. There wasn't a global alliance against Russia. And secondly, in this specific instance, because we were in an inflation environment, and especially because in Europe, there was a surge in energy costs, which is, from a political perspective, very detrimental for politicians to face that. There was an incentive for people to cheat.
So practically what you are saying is that people are cheating because the cost of sanctions is unbearable.
Correct. In essence, yeah, that's right. Yeah.
But this whole thing is known for a very long time. I have recently come across a paper published by the Peterson Institute for Economic Studies, based in Washington, D.C. And the paper dates back to 1997. They say basically the same things which you are saying now. So it's all been known, and nevertheless, the same mistakes get repeated all over again. That paper, by the way, considered the cost of sanctions for the US economy. At that time, it estimated the costs to translate into approximately 200,000 jobs in the US, and again, mostly in highly paid, export-orientated sectors, which produce sophisticated equipment. And here we go again.
Yeah, I mean, if you look at the international relations literature, it's very clear that on balance, it's evident that sanctions don't work. At the same time, from a political perspective, sanctions are kind of easy to implement. You make a big headline, it sounds good, and it's just something that is very appealing at one level. I would say, though, in this specific case, the US, I think, has gained economically from the sanctions on Russia, because in essence, what's happened, but Europe has lost. In essence, what the US has done is that it's now gained a new natural gas market in Europe. So the US, in essence, was saying to Europe, and they've been saying this for a long time about Nord Stream, that buy US natural gas, LNG, don't buy Russian energy. And essentially, that's what's happened now. So the US, I think, has gained from the sanctions in this specific instance, whereas Europe has been the clear loser here. So I think in general, it's true that sanctions don't achieve their objectives first. And secondly, there's often the large economic cost, in this case, Europe. But often there is a winner somewhere along the lines. And I think today, US has in particular gained quite a lot in terms of it's been able to capture the European market now for its LNG exports.
And given that, Bilal, I mean, what is your prediction? I mean, do you think the West will continue to tinker with these sanctions? Some of the sanctions against Russia, of course, go all the way back to 14, they're 10 years on. Will the West continue to tinker with it, try and tighten up the regime? Or do you think the sanctions will slowly start to lose their force as Russian oil is retankered and clearly they're having no difficulty in selling it?
Yeah, no, it's a good question. I mean, I think there will be sort of tinkering, further ahead. I mean, to some extent, I think the whole oil trade is kind of happening irrespective of the sanctions. The larger one is there a scenario where the Europeans would somehow re-import Russian gas? And I think that's harder to see, because I think there's so much sensitivity around that even if they lifted sanctions on natural gas now, it'll be hard for them to start to import that. That's kind of the critical sanction that matters. I think there will be lots of face-saving sanctions. They'll talk about sanctioning oligarchs, this, that, and the other, just to kind of show that there's still pressure. But I think the key sanction that would make a difference to Europe will be to re-import natural gas from Russia. I think that's a harder one, I think, for it to sort of politically work, even if the sanctions were sort of lifted.
Yeah, so they're reducing the dependence on Russian gas is gone. I mean, that's not going to come back.
Exactly, yeah.
Bilal, you said that the US is a winner and Europe, and probably you meant continental Europe, is clearly a loser. What's your view about the UK?
Yeah, it's a good question. I think the UK is also at the margin a loser as well from all of this, because they have some level of dependence, to European energy production, because the UK imports a lot, from that. And in essence, what's happened within Europe is that because of the absence of Russian energy, that's kind of just raised the cost of energy production in general, which impacts the UK. So there's no way, all the talk of Brexit and everything, just from geography, it's impossible for the UK to decouple itself from Europe. There's just no way that can happen. Economic theory, look at trade relations, you just can't change the geography there. So in the end, the UK does lose out from all of this. Well, what the UK does have is that its plans around nuclear, its renewables, that does give the UK some kind of offset as well. But that's more of a longer term story there.
Is there any way to estimate in monetary terms how much a country, let's say the UK, has gained or lost? I have provided this number or this estimate for Germany. It would be very interesting to see what it means for this country.
Yeah, it's very hard to determine because there's been so many factors affecting the UK. It would definitely be smaller than, say, for Germany, because the issue with Germany specifically is they had a very specific economic structure that was linked to cheap Russian energy. Now, the UK just doesn't have that structure. The UK's manufacturing sector is much smaller than the German one. It has the largest services sector. So in that respect, it's less clear what the overall impact is.
But we've had higher food costs probably to some extent
Yeah.
from
Yeah.
the sanctions, from the war in Ukraine, and higher energy costs, as you said. So
Yeah.
those two
Yeah.
must be
Yeah, so that
must
has
be
had an
measurable.
impact. Yes, that's measurable. I mean, just kind of having a rough estimate, I would, say that's probably like 20 to 50 billion pounds or something like that, if you accrue it all. But these are just rough estimates here.
You mentioned another interesting thing, which is that German companies are relocating some of their production to China. And here we are speaking about geopolitical risks. If there is a deterioration in the relationship between the West and China, then, and for example, more severe sanctions imposed on China, what is going to happen to all these companies? We have seen what has happened to the foreign business in Russia, and it's not a very good story. China is much bigger, and German production, not only German, but any foreign production in China is a very big thing.
Yeah, absolutely. I would say China is in a whole different universe compared to Russia, because in essence, in terms of Russia's impact on the global economy, Russia's real impact is in terms of its commodity exports, whether it's energy or agricultural sort of goods. It's not really a big economy in the sense that it moves the world economy. Now, China's the second largest economy in the world. It's the largest economy in the world on a PPP basis. It's the largest, manufacturer of goods and stuff in the world. It has large foreign reserves. It's integrated with the global financial system in a way that Russia isn't. So it's a whole different ballpark when we talk about China. So, if the US was to, or the West were to impose the exact same sanctions on China that it did on Russia, that would cause like a global financial crisis in essence. It's a whole different thing, because China being the second largest economy in the world, if you impose sanctions on such a large economy, that would immediately lead to a huge drop in global growth. Then China's size of its economy in terms of the financial system, if you freeze its reserves or those sorts of things, that would really block up the whole global financial system, because then China suddenly would have to shift all of its dollar assets into some other market. It would accelerate a decoupling from the US financial system. It would cause all sorts of different problems. So for that reason, I don't think we'd ever have a scenario where there was as extreme sanctions as we saw in Russia on China. Instead, I think we'll see a continuation of what we're seeing at the moment, which is, in essence, what the US is trying to do, is that it's trying to slow down the development of China, especially in the tech sector. So what the US is saying is that it's okay for China to produce like low value added stuff. But in terms of cutting edge sectors, they want China to slow down or to be impeded so that intellectual property doesn't belong to China. Instead, it's the US and the West that has the most advanced technologies. So that's what the US is trying to do. So it's basically trying to sort of slow down. It has import restrictions, export restrictions on certain chips. High-end chips can't go to China anymore. There's restrictions in terms of what exports Chinese tech companies can have into the US. There's all sorts of restrictions on Chinese nationals now working in the US, for national security reasons. So the US has a very clear, and this is bipartisan, both the Republicans and the Democrats agree on this, to contain China in much the same way as you could say the US, had the Cold War with the Soviet Union, where it was all about containment but not open conflict. You now have the same with China. And with the Soviet Union, you could have said it was around like nuclear weapons. That was what they're trying to stop. With China, you could say it's tech or AI. It's an AI kind of Cold War, you could say, where they don't want China to be able to have the technology that will enable them to have an advanced AI sector, because AI necessitates a very advanced tech stack, you could say.
Bilal, do you expect that to be matched on the European side? Do you expect the Europeans, we've seen a lot of national security legislation and so on. Do we expect the Europeans to keep that front up and to replicate what's been happening in the States? Or do you expect the two sides of the Atlantic to slightly diverge when it comes to restricting the move of China up the value chain and the import of the kind of technology and IP they need?
Yeah, that's a good question. I would say Europe is diverging and wants to diverge. I mean, Europe basically has a different relationship with China. I mean, they basically have much more of a balanced relationship with China. They don't necessarily see China as a pure adversary. Instead, they see China more like a partner. And for good reason. They have strong trade relations with China, and they had that for a long time. And then you have countries like Italy that have benefited from direct investment from China. It's from the Belt and Road Initiative. So Germany has a trade link. Italy has an investment link. So there's much more stronger ties, to China. So Europe has to tread this fine line between managing its relationship across the Atlantic with the US, but also maintaining its economic relationship with China. So my general sense is, if there wasn't pressure from the US, Europe would not really have that many restrictions on Chinese tech. But because there is pressure from the US, they have to give something up to make sure the US doesn't get too upset with Europe. Now, the UK is a bit more allied to the US when it comes to foreign policy, so there's probably a closer alliance there. But at least for content to Europe, I think they're much more reluctant to try to be too aggressive towards China.
When this whole conflict began, and probably we're speaking about 2014, I mean, the conflict between Russia and Ukraine, the move of Russia towards China was pretty apparent. All of a sudden, Russia, which was before orientated towards Europe, found a new friend, a more senior friend in China. And China, on the other hand, has got a great supplier of cheap energy and other resources. But also China is taking the Russian-Ukrainian crisis as a data point. And probably they're learning from this data point about what to expect, how they are going to be contained in the future. One of the things which they can learn is the possibility of freezing their assets abroad. And as far as I remember, China is currently the second biggest holder of US treasuries. It's around $1 trillion. And I think there has been some trend towards a reduction of this amount. Do you think these two things may be related? And what is going to happen if China actually continues this trend of reducing their dependence on the foreign financial system?
Yeah, I think absolutely. I think all countries, not just China, took notice of the way Russian assets were frozen. I mean, that was very unusual from a historical perspective. Even during the Second World War, Nazi Germany's assets weren't frozen in the same way the central bank assets. So this was a very unusual situation. It did happen with Afghanistan during the Afghanistan war, the recent Afghanistan war, but with a major economic power, it's never happened before. So this is very unusual. China, I think, has taken notice. So what China has done is two things. Number one is they've accelerated their Chinese-based payment system that they have. So China has its own payment system, and they're trying to extend it to other countries for them to be able to have a renminbi-based payment system. Secondly, they've started to ask trade partners to trade in renminbi rather than US dollars with them. So, for example, they now do trade with Russia in renminbi rather than US dollars. And same with Saudi as well. They're trying to get all the oil producers from the Middle East to trade in renminbi rather than in dollars. So there's kind of a shift there. Now, in terms of what this means for, say, the dominance of the US dollar in the global system, this does suggest that there is going to be this long-term move by other countries to find ways of having a system that insulates themselves from the dollar system, whether that's India, Brazil. I think there will be moves by all of these countries, but that will take time. And for me, the real test of the dollar's dominance is, when you get two countries who are not dollar-based, what third currency do they deal with? So, for example, if Indonesia trades with Brazil, what third currency do they use to trade with each other? Do they go through the US dollar, or do they go through the renminbi? At the moment, they still go through the US dollar. So the only people that are using renminbi are the countries that are trading directly with China. So if we saw a situation where the Indonesia-Brazil trade went through renminbi, that's significant because that trade has nothing to do with China, and now people are choosing the renminbi. That hasn't happened yet. So as soon as that starts to happen, then there's a challenge to the dollar. At the moment, it's not happening. So for me, the whole thing around the end of the dollar because of this is too early to say, even though China is trying to build up an alternative infrastructure.
But it seems inevitable that China will try to create some kind of broad economic central grouping that does allow them to resist this kind of US policy in the future.
I think they will try. I think they do have some challenges, not least because within Asia, the other two economic powers, you could say, are India, who don't particularly like the Chinese, and Japan, the other big economic power who don't particularly like the Chinese. So their challenge is that within their own region, you have two blocks that don't necessarily want to cooperate with the Chinese. So the challenge for China is to find good allies around the world, and that's not so easy for them to do. But I think they're going to try, and they're going to incentivize lots of different countries through different means, through either investment or loans and those sorts of things. But it's not very easy to do that, and that's why it hasn't happened already.
I'm dying to ask you, Bilal, whether you are optimistic about China, whether they can move up the value chain, whether they can move their economy towards, consumption growth rather than investment-led growth. The middle classes there have become very dependent on their investments in property and shares, whether they can, under their political system, whether they can engineer the kind of changes that are now needed to move that economy forward.
Yeah, it's a great question. I mean, firstly, I think that them moving up the tech value chain towards AI can be done without rebalancing the economy. They can do that through a state-led approach where they build high-tech chips, AI, all of those things. I think they can kind of do that, without necessarily rebalancing the economy. So I think they will be fairly successful on that front. But in terms of rebalance the economy, I'm a bit more pessimistic because there's been so many. I mean, we've all talked about rebalancing for such a long time in China, and they themselves have been talking about it, but they haven't done it. Why is that? I think it's because of the incentive structures internally just don't align in that way, because one is you have centralized power, a lot of state intervention, and things are moving much more towards state intervention and control and loyalty than it is towards the economy. One kind of measure of that is the most kind of high productivity, economically dynamic part of the Chinese economy is the private sector, which in general is being stifled on multiple different fronts in terms of access to credit, in terms of having to have a representative of the Communist Party on their boards now. So that's all kind of happening, on an ongoing basis. So I think the rebalance is going to be very, very hard, I think, for them to do. And all the measures they've taken in recent years has, if anything, gone against that. So I'm fairly pessimistic on that side.
Bilal, if we go back to the question about risks which are introduced by the geopolitical tensions we have already touched upon. In this regard, it's quite interesting to remember the story about how the US got involved in the Second World War. And everybody knows that it was when the Japanese attacked Pearl Harbor. But not everybody knows that actually the Japanese did not attack Pearl Harbor just out of the blue. It was a direct result of the Japanese first invading China, and then the US, the UK, and the Netherlands introduced sanctions on Japan, oil embargo, and then the US froze Japanese assets which were held in the US. And then Japan was feeling choked. The way they chose was to attack Pearl Harbor. So this was certainly not a response which the US expected. Are you seeing any possibility of any such development in the current situation?
Yeah, I would certainly say that some of the developments over the last 4 or 5 years have been very troubling. And I think there's a few different sort of dynamics here that make me concerned. At the same time, these things are very hard to predict. So that's kind of a caveat I would have. One thing in general is that we're living in more and more in a multipolar world, where there's different power blocks. And there's no, like in the 1990s, you could kind of say the US was the top dog. It was a unipolar world. Soviets were the breakup there. China wasn't so big, and the US kind of was the big guy. Now it's a multipolar world. Economically, you have US, China, then maybe Europe somewhere in the middle. There's all sorts of different alliances between emerging market countries that are sort of developing. I think the US lost a lot of credibility also with the Iraq and Afghanistan wars. What's also interesting is that we're in an inflation environment today. And the reason I mention that is that inflation in particular tends to make a lot of people unhappy on the streets, in a way that even a recession doesn't, because an inflation just makes people be poorer. They see it every day that their sort of their pay packet doesn't take them so far. So if you look at the last period in the West, even of inflation was 1970s, and that was a period of a very high level of public dissatisfaction. There was lots of activism, terrorism, the anarchist groups. I mean, it was like a big period of upheaval. So that kind of backdrop, is also quite significant. And then also, if you look at the rise of populism in the world, which I think in part is to do with, you could say, the failure of neoliberalism. So you could say that from the 1980s up until the 2000s, there was this kind of consensus that free markets, less state intervention was the way to grow an economy and to make everyone happy and rich. And since the global financial crisis, that orthodoxy has gone. Initially, policies that were employed after the GFC didn't really work, austerity. Now, since COVID and the rise of Trump and populism, there's kind of an alternative set of policies that are being advocated for, which is much more economic, sort of nationalism, more focus on let's do the best for our own country, let's care less about other countries. So all of this provides, a nice backdrop for more, interstate conflict. Then the conflicts we're seeing, we have Russia, Ukraine, obviously, there's possibility of China, sort of Taiwan, then the Middle East as well, I think is also quite significant in the sense that what you've seen there is that what was interesting is after the initial attack by Hamas on Israel, there was a lot of solidarity behind Israel around the world, but then with the ongoing bombardment by Israel on Palestine in Gaza, that support has started to go away. If you look at polling across the world, and it started to fracture international alliance. So if you look at recent UN votes, it's really the US alone that keeps vetoing everything. So that kind of causes like an unhealthy kind of set of alliances. And the Middle Eastern countries like Egypt, Saudi, at the top level, they're kind of implicitly supporting Israel. They kind of have an economic relationship, but the people on the street are clearly on the Palestinian side. So if you have some change at the top, I mean, suddenly it opens up the whole region in a way that we didn't expect before. So I think there's all these kind of things that could pull people into a conflict. And of course, the other thing is, after the Iraq and Afghanistan war, we thought we wouldn't really have any more wars for the West to get involved in. Now we have both the US and the UK bombing Yemen, for example. I mean, they can call it strategic, bombing and stuff, but we're kind of dragged back into a Middle Eastern conflict, just like that. So it definitely feels like something could happen, and I think a lot of the backdrop ingredients are there in terms of neoliberal orders, breaking up international alliances, inflation, all of these factors. So certainly I think the risks are very high, but I can't make any predictions about some kind of World War III here.
Do you think the markets are pricing these risks in?
Not really, no. I think what's interesting in terms of markets, and I think it's probably been fair to some extent, is that on the outbreak of any of these conflicts, whether it was Russia, Israel, and Palestine, there was an initial market reaction, but within either a few months after Russia, Ukraine, or a few days in the case of Israel, Palestine, markets kind of went back to normal. And in essence, what the market is saying is that for now, they don't think that the conflict or the sanctions will have any major disruptive forces on oil markets or on the global economy. Also, what the markets are saying, if you look at the performance of equities and interest rates, they're basically saying the risk of some kind of major conflict between the major powers is close to zero. So markets are not expecting anything on that front.
Yeah, but at the same time, the markets didn't expect anything and didn't react in any way before the Russia-Ukraine conflict, even though the U.S. intelligence was shouting that there was a possibility and almost inevitability of the Russian invasion. And nevertheless, the markets were absolutely nonchalant.
Yeah, absolutely. I mean, the markets aren't always right, for sure. And that's why, I mean, what drives markets in the end are surprises. If there's no surprise, the market price won't change. So it's always been moved by prices. So the fact that the markets aren't pricing an event does not tell you anything about whether that event will happen or not. So I would certainly say that the market could be underpricing that risk. But then me as somebody in markets, and I speak to investors all the time, I'm hesitant to put a trade on to position for a conflict, say for the next 12 months. If I said, okay, shall I put a trade on that I'll benefit, the trade will do well if there's a conflict in the next 12 months. I just think it's so hard to predict. And I just think that, okay, China, I don't think wants to invade Taiwan right now. So I don't want to put too many odds on that. Israel, Palestine, okay, maybe that will just carry on going and won't, spill over. Russia, Ukraine, we seem to have some kind of, stability there in terms of the conflict. I mean, not stability in the sense of, it's hard to, the balance of risks there on Russia, Ukraine is that you get a Trump victory in the US elections, and then that somehow reduces sanctions on Russia, which ends up benefiting the world economy. So the risk there could actually be the other way, a more positive direction in terms of risk. So when you start to narrow it down to a very narrow, shorter time frame and try to work out the odds, it's hard to have too much confidence about putting a kind of a big war trade on, so to speak.
It's an interesting point about Trump coming to power, benefiting the world economy, because he will not impose so severe sanctions on Russia as Biden. That's interesting.
Well, just on the last point, I mean, do you think the markets are pricing in the risk of particularly pressure on some of these choke points in international trade? Did they foresee that the Red Sea would come under attack from the Houthis, that we could in fact see some quite significant disruption there? We could see it in the Strait of Malacca as well. I mean, do you think the markets are pricing in the extent to which these conflicts are beginning slightly to merge now?
Yeah, no, it's a great question. And I think you're right. Markets, number one, they didn't predict the Red Sea, fallout. And I think part of the reason was that initially when the Israel-Palestine, conflict started back in October, there was an initial focus on Iran getting involved somehow. So whether it was Iran actively, using proxies to attack Israel, or Israel directly attacking Iran. So all the focus was shifting to Iran. And instead it was the Red Sea. No one expected the Houthis and the Red Sea side to come up. So for sure, it's completely unexpected. And in hindsight, you could see the logic, but what that almost tells me is, especially the Middle East conflict, I have to say, there's been so many strange, unexpected developments. So one is the Red Sea sort of dynamic, which we didn't expect. The other has been that Iran hasn't really been involved in any sort of major way, which you would have thought by now they would have been drawn into it all. The other was that you had that odd conflict between Iran and Pakistan that lasted like a week. And so there are all these unexpected, outcomes. So for sure, I think the market is underpricing these risks. The Straits of Malacca, obviously, that's more linked to China then, and about whether the US would try to use the Straits of Malacca or the Indian Ocean to kind of somehow block Chinese trade. But I think if you look at both the Biden administration and what Trump is likely to do, neither one of them seem to be focusing on that. Instead, Biden is very focused on starving strategic sectors of China of resources, and Trump is focused on tariffs. So, on the US side, I don't think they'd advocate for a blockade on that side.
Do you think that the imposition of tariffs by Trump is realistic?
I think that he will try to impose tariffs, and he did last time. And this time around, he's talking about 60% tariffs on Chinese imports.
Which is not going to benefit the world economy.
No, it's not. No. And if you do look at what's happened to China-US relations or trade relations, what China did initially when tariffs were imposed, they just weakened their currency to offset the tariffs, so that for US imports, the renminbi was weaker, so it offset the tariffs so that trade could be the same. Then what they did was they shifted their exports to Mexico and then used Mexico then to re-export it back into the US without tariffs. So effectively what's happened is Chinese exports to the US have fallen in the last 3-4 years, but their exports to Mexico have shot up in the last 3-4 years. So again, this is one of those things where people find a way around tariffs. So they're effectively going via Mexico into the US. So in that sense, the economic cost has been lower. I mean, it has been neutral, you could say, in the end, because they just went round a different route back in. So the question then is, would Trump have a sophisticated policy on where did the goods come from originally. And that's much more harder to monitor and impose, because China could then go via Vietnam and Myanmar, Malaysia, then to Mexico, and do it that way around. And it just gets messy when you get to those levels.
And more expensive anyway, because there are so many intermediaries.
Yeah.
All right, Bilal, this has been super interesting. Thank you very much for being with us.
Great, it's been a pleasure. Thanks a lot for some really fantastic questions.
Thank you.
Goodbye. Thanks.
So he's an interesting guy, that's for sure, and he's a very smart person. I've known him for a very long time. His views are unorthodox, I would say.
Very interesting, I think, looking backwards on the actual effect of sanctions.
It's also quite a realistic view about how people circumvent sanctions.
Yes, I think the key takeaway is that sanctions are political, essentially. They're a comfort for politicians. They want to be seen to be doing something, but they're not necessarily properly economic in their effect.
Thanks for listening. This has been Capital Horizons.
So if you'd like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.